AI Regulation 2026. What every bank CEO needs to know. If you're running a bank or financial institution today, you felt it. The ground is shifting beneath the industry, not because of interest rates, not because of liquidity concerns, but because artificial intelligence is reshaping banking faster than any technology in the last 50 years. And now, in 2026, the technology is no longer the story. The regulation is. This is the year when AI regulation stops being a distant conversation and becomes a direct operational responsibility for every bank CEO. Not something to delegate, not something to circle back to, something that will define the compliance posture, risk exposure, and competitive advantage of your institution for the next decade. So let's talk about what's changing, why it matters, and how you can lead from the front without getting overwhelmed by the technical noise. Why this matters now. Over the last 2 years, banks have deployed AI at an unprecedented pace. You've seen it in credit underwriting, fraud analytics, AML automation, risk modeling, customer service, marketing optimization. Nearly every function has been touched by some form of machine intelligence. But here's the part that's catching many executives off guard. Regulators are not only aware of this shift, they're accelerating their response. And they're making it clear that financial institutions will be held to a higher, stricter, more transparent standard than any other industry. Why? Because banks don't just manage data, they manage economic stability. They manage livelihoods. They manage systemic risk. This is why global regulators, from the US to the EU to the UK to Asia, are signaling a unified expectation. Banks must demonstrate that the AI they deploy is explainable, traceable, accountable, and properly governed. Not eventually. Not when the technology matures. Now, AI regulation is becoming as fundamental as capital adequacy, as essential as cybersecurity, and as non-negotiable as KYC. The big shift CEOs must understand. Most executives are used to thinking about AI as an innovation lever, something that improves efficiency, boosts productivity, or modernizes customer experience. But in 2026, the conversation evolves. AI is no longer viewed as a tool. It becomes a risk category, a regulator-monitored function, a mandatory governance domain, a requirement with real supervisory consequences. The shift is subtle, but the implications are massive. Boards will now be expected to maintain direct oversight of AI systems, the same way they oversee cybersecurity, operational risk, and liquidity buffers. That means AI governance is no longer a technology issue. It's a leadership issue. And once you see it through that lens, everything else begins to click. The hidden pain points bank CEOs often miss. Let's talk about the operational realities inside most banks right now. Because this is where AI regulation intersects with everyday business. The first challenge is something many executives underestimate: the rise of shadow AI. Employees using unapproved tools. Analysts copying sensitive data into public systems. Teams experimenting with generative AI on their own. It's happening in nearly every institution, whether leadership sees it or not. Shadow AI is currently the #1 internal AI risk for financial institutions, and in 2026, regulators will expect explicit controls to contain it. Another challenge is vendor AI exposure. Most banks today use third-party systems that incorporate AI behind the scenes: fraud systems, risk scoring tools, decision engines, CRM platforms, you name it. But under the new frameworks emerging in 2026, regulators will treat vendor AI risk as your risk. If the vendor can't show governance, lineage, explainability, or fairness, your bank is the one exposed. And then there's the issue of model drift and data lineage. AI models evolve over time. They degrade. They produce different results based on different data. Regulators want to know exactly where the data comes from, how the model changes, and how you track those changes. Most banks are not equipped for that level of scrutiny yet. But the most sensitive area, the one regulators are watching especially closely, is algorithmic bias. Any AI system involved in credit, lending, fraud, or risk scoring will be monitored for disparities and unfair outcomes. If your AI impacts credit decisions in any way, fairness is no longer a best practice. It's an enforceable requirement. These are the pain points every CEO must start anticipating now, because this is where regulators are already aiming their attention. The 4 pillars every executive should build. Now let's get practical. As a CEO, you don't need to understand model architecture, training pipelines, or neural structures. You don't need to know the technical internals. You do, however, need a clear governance model that proves your institution is managing AI responsibly. And that comes down to 4 strategic pillars. The first is an enterprise-wide AI policy framework. This isn't a memo or a guideline. It's a formal board-approved framework that defines what tools are allowed, how data must be handled, what vendors must disclose, what documentation is required, and what employees are permitted to use. Without it, compliance becomes guesswork. The second pillar is an AI inventory and classification system. Regulators will expect banks to maintain a complete, living inventory of every AI system in use, internal or external, along with risk classification, purpose, data sources, and governance oversight. Think of it as the new catalog of operational intelligence. The third pillar is model governance and explainability. This isn't about exposing technical code. It's about demonstrating that the bank can articulate how a model works, why it made a decision, and how it was validated. For high-risk systems, explainability isn't optional. It's mandatory. The fourth pillar is human-in-the-loop oversight. No matter how advanced the AI is, regulators want to see that humans, not algorithms, maintain final control. You need a clear system of review, escalation, and validation, showing that AI doesn't bypass human judgment in critical decisions. When these 4 pillars are in place, your institution moves from reactive to prepared, from uncertain to audit-ready, from vulnerable to strategically protected. A look at what's coming in 2026. So what does AI regulation actually look like as we move deeper into the year? We can already see clear patterns forming across global jurisdictions. Expect mandatory registration for certain high-risk AI systems. Expect explainability standards that apply specifically to decisions involving credit, fraud, and customer identity. Expect continuous monitoring expectations, not annual audits, but ongoing evaluation. Expect requirements for incident reporting when AI behaves unexpectedly. Expect increasing scrutiny of vendor systems. Expect emerging AI compliance certifications, similar to SOC 2 or ISO, but tailored for AI governance. For forward-thinking CEOs, none of this should be viewed as a burden. It should be seen as a blueprint, a clear roadmap of what good AI behavior looks like in a regulated financial environment. What you can start doing now, without going too deep. I'm not going to dive into the full detailed playbooks here. Those will be available inside our upcoming membership platform, where you'll get the complete frameworks, templates, assessment tools, and implementation guides. But at a strategic leadership level, here's where I recommend starting. Establish a bank-wide AI governance charter. Put accountability in writing. Define who owns what, who approves what, and who documents what. When governance is vague, compliance collapses. Next, consider forming an AI risk committee. It can operate similarly to your cybersecurity or operational risk committees, but with a focus on AI oversight. Regulators appreciate seeing this kind of structure because it signals maturity. Then, initiate a regulatory impact assessment across all your AI-connected tools. Even if you only do a light pass, you'll uncover where the biggest exposures are. Prioritize the tools that affect customers, credit decisions, or financial risk. Develop a vendor AI checklist. This alone can shield your institution from significant downstream exposure. And finally, train your leadership teams, not on technical AI, but on AI risk literacy. Your executives need to understand governance responsibilities, decision oversight, ethical expectations, and regulatory requirements. This is the kind of training that turns a bank from reactive to proactive, and regulators notice it immediately. A quick but critical compliance warning. Before you start implementing anything, there's a mistake I want you to avoid, because I've seen it cost financial institutions millions. Do not let your AI compliance strategy be driven by your IT or data teams. Technology should support compliance, not define it. AI governance must be owned by risk, compliance, audit, and executive oversight. When the technology team leads AI strategy, governance gaps multiply. And regulators always find the gaps. If there's one thing you take away today, let it be this. AI strategy is leadership strategy, not technology strategy. Bringing this all together, AI regulation in 2026 isn't something to fear. It's something to prepare for, to lean into, and to use as a competitive advantage. Because the banks that master AI governance will be the banks regulators trust, and the bank's customers trust. This is the year to build clarity. This is the year to build structure. This is the year to build the frameworks that will protect your institution for the next decade. And if you want the full models, templates, assessment tools, and implementation playbooks, be on the lookout for our upcoming membership platform, where we'll break all of this down step by step, so your institution doesn't just stay compliant. It stays ahead. Key takeaways. AI regulation becomes a top-tier leadership responsibility in 2026. Banks will face stricter expectations around transparency, explainability, and governance. Shadow AI and vendor AI exposure are major emerging risks. 4 pillars matter most: AI policy framework, AI inventory, model governance, and human oversight. Regulation will include system registration, continuous monitoring, fairness requirements, and vendor accountability. CEOs should begin implementing strategic charters, risk committees, vendor checklists, and leadership training. The biggest mistake to avoid is letting IT, not risk or compliance, drive AI strategy. Full solutions, frameworks, templates, and guidance will be available in the upcoming membership platform. Before you go, make sure you subscribe to the channel so you stay informed and never miss any of the value-packed content we release, especially as we get closer to launching our highly anticipated membership platform. That platform will give you the deep dive analysis, the strategic insights, and the real, actionable solutions you need to navigate AI regulation and compliance intelligence in financial services with confidence. And if you've gained any value from this video, and I hope you have, go ahead and click the thumbs up button. It helps more leaders discover this content. Then leave a quick comment below saying, "I love these AI regulation and compliance intelligence for financial services video contents," as a thank you for the work we put into creating these resources for you. Your support helps us continue delivering the intelligence, clarity, and strategic guidance every modern financial leader needs.